Startup and business news this year has been a constant stream of investor revelations. Unsinkable household name brands are losing their funding, their trust, and their runways. Many of the highest funded companies of 2021 now lead the pack in layoffs. What happened? Here's a clue. It started in the late 90s. More on that in a second. A wave of investor readjustments has come yet again. This means it's time for startups, young, old, or yet unborn, to get back to the basics of startup sustainability and to avoid the pitfalls of starting a startup for the glamour of it all.
There's a lot of shine, and now there's movies, on Netflix about, these great startup founders, and I think it's a lot harder than people think it is. It's a roller coaster, and there's no straight line to success on any level.
We'd like you to meet Kyle York, a foremost expert on how startups can build successful companies sustainably. As chairman of the Entrepreneurship Executive Council, serial entrepreneur, and founder of the investment and advisory firm York, we needed to call him up to talk more about this issue. Turns out there's a weird startup habit that's developed since the dot-com bubble in the 90s. Act fast and gain users first. Develop your revenue model and devise a strategy later. Startups using this method are able to attract eager investors early in their development through the use of things like vanity metrics. Kyle, can you share some insights you have about vanity metrics?
You tend to hear about these companies with 100K ARR raising $50 million at a $300 million valuation. And to me, everything I just said there about the ARR is a vanity metric, right? So vanity metrics are just these sort of non-fundamental business metrics that get used to size up or celebrity-atize, if that's a word, startup founders and startups. And this ends up being the doom of the, I could name names, but, of the companies that sort of get big, raise tons of money, and then plateau and die. It's sort of the avoidance of the ego and the celebrity around the startup landscape and what it means to build a good, healthy company and focus more on the fundamentals.
Thanks to having a cushion of cash, startups that don't have a sustainable plan at the start can put off developing one until much later, or not at all. As they continue to attract more funding, they assume these wrinkles can be ironed out while they scale. But instead, those wrinkles can simply get bigger. Oof. These vanity metrics are able to attract eager investors, but once reality starts setting in, investors might start raising concerns. They may even decide to pull out should things get bad. But it's not like people would call Netflix, Lyft, or Airbnb unsuccessful, even though they don't turn a profit. There's plenty more companies that don't make daily headlines and may not even be household names, but they're still highly successful and sustainable in what they do. So, Kyle, how would you personally define success?
The way I build my companies is the same way I build my career. Set a long-term vision, know what your North Star is and where you want to go long-term. Be super loyal along the way to your mentors and your mentees and the people around you and the team that you need to build to get there. And then work your way back, and make sure that every decision, every career move you make fits into that long-term narrative and that long-term vision for yourself, and that you're kind of making yourselves get there along the way. And you have to define what you're trying to build and what success is to you, and not care what anyone else thinks about that. So I think that's the other thing. Success is relative. Remember that. Try to have fun along the way. Just win. But winning is also incredibly relative.
That's great insight, Kyle. If you want to hear more about building strategically in this new investor climate, check out the Full Length podcast here on YouTube, on your favorite streaming platform, or at startupsavant.com.